Yeah, we getting ready for Money Mondays. If you're watching the replay, feel free to skip ahead past the countdown timer. If you're live, come hang out with us as we get ready for the live show. Welcome. While we get ready for the show to start, let me know where you're watching from. Are you watching on Facebook or are you watching on YouTube? I want to see. We're going to do Facebook versus YouTube. Let me know which platform you're watching on. And leave a comment below where you're watching from, what city, state. And we'll go kick it off. Michael in the building from Charlotte. So we know Facebook is in the building. Welcome to the party, my man Michael. Facebook showing up. Where YouTube at? If you're just joining us, let us know where you're watching from, which platform, what city, what state. We'll be getting into the 4 trading styles here shortly. Got a few minutes before we kick it off. That's enough time for you to hit the like button, subscribe button. It's enough time for you to invite your friends. There we go, YouTube in the building. John Banks letting us know YouTube working. John Banks from CA. I don't know if that's California or Canada.
We could break up and then make up. I always come back to you. You move me in a way never thought anyone could. You give me
Chris Manson in the building. I like that image. You got like 2 screens up. I like that. I like that. 5 minutes, y'all. Hit the like button. Hit the subscribe button. Invite a friend to check out the live show. If you're watching the replay, you get to hang out with us, listen to some cool music, or you can skip past it if you're watching the replay.
You touch me in a way that makes me shiver. Sometimes I can't believe that you are mine. Love's a gun and baby, you're my trigger. You kiss me in a way that gets me high. You make all my dreams come
Nice.
It feels right. Just being around you. We could break up.
I might have to bring the whiteboard out today.
Come back to you, you move me in a way never thought anyone could. You get me high, you're my drug when I am feeling blue. Yeah, it's all you, 'cause you're the one. Yeah, the one.
Yeah, we might have to bring the whiteboard out today.
Yeah, you're the one. Yeah, the one. Yeah, you're the one, babe. Yeah, you're the one.
Bernie Castro in the building. Welcome to the live stream, Bernie.
Yeah, you're the one.
Keith Williams from Birmingham, Alabama, in the building. Thanks for joining us, Keith.
Spend my coin for sure. I'm gonna be myself, or I could be someone else. No one stopping.
I think I got my girl Michaela hanging out with me, handling the chat, comments. So if you see me responding, I guess it's me, but it's me through Michaela on my team. She's holding it down. Michaela, say hi to the people.
Hold me down, feel alive when I'm in this town. Look at those beautiful stars. I wanna drive a faster car. Nothing can break me. No, nothing can break me. Try not to hold me down, feel alive when I'm in this town. Look at those beautiful stars. I wanna take a trip to Mars. Nothing can break me. No, nothing can break me. Drive a faster car.
Grashard Johnson in the building from Arizona. Welcome to the party. Calvin Price, loving M&Ms. I don't know if that means he eating candy or something right now, but
I'm gonna be
we with
myself, or I could be someone else. No one's stopping me now. I'm gonna skip my breaks. I'm gonna make mistakes. I just wanna feel alive. It's just what I do when I'm out, so try not to hold me down. Feel alive when I'm in this town. Look at those beautiful
let's see,
stars.
who do we got more people watching from
Nothing can
YouTube
break
or
me.
Facebook?
No, nothing can break me. Try not to hold me down. Feel
YouTube
alive
at 28.
when I'm in this town. Look at the beautiful stars. I wanna take
Facebook
a
got
trip
a
to
few, they
Mars.
dropping
Nothing
off.
can break me. No, nothing can
Ronnie
break
Jackson's in the building. Welcome. Douglas Montgomery. Dempsey Girl, welcome to the party.
Stars, I wanna drive a faster car. I'm gonna be myself. I'm gonna be someone else. I'm gonna be myself. I'm gonna be someone else.
Okay.
I'm gonna skip my breaks. I'm gonna make mistakes. I'm gonna
22
skip my
seconds, y'all.
breaks.
We
I'm
finna get
gonna
into
make
it.
mistakes. I'm gonna be myself. I'm gonna be someone else. I'm gonna
Talking about
be
the different
myself.
types of
I'm gonna be
traders.
someone else. I'm gonna skip my breaks. I'm gonna make
Ronnie
mistakes.
Jacks.
I'm gonna skip my breaks. I'm gonna make mistakes. Try not to hold me down. Feel
What's up, everybody? I'm your host, Jason Brown, and we're doing Money Mondays. So, whether you're watching live on Facebook or whether you're watching live on YouTube, welcome. This is the channel where we're talking about money, markets, which means the stock market and mindset. And every Monday, we go live for Money Mondays where we pick a topic to try to help you get closer to the money, baby. That's right. We want you to come out of this pandemic a little smarter, a little wealthier, and with some skills that maybe you didn't have before you went into the pandemic. So, welcome to the party. Yeah, because that's exactly what this is. So, today we got a pretty cool topic that we're going to be talking about. And we're going to be breaking down the different styles of trading or investing, however you like to look at the stock market when it comes to putting money to work, as long as you don't look at it as gambling, right? But for trading or investing, we're going to be talking about the four different styles of investing. And one of the things that I think this industry does wrong or backwards, or that I see sometimes, is sometimes I see people bashing a style of investing or a style of trading. And the reality is that everything works and nothing works. And so, what I mean by that is whether you're a long term trader, day trader, swing trader, crypto trader, you are a Forex trader, everything works and nothing works. You can take any sector, industry, style, and I'm sure you'll find somebody that's making money in it. But in our industry, sometimes we tend to bash other styles of investing, right? And and so I kind of want to put either the style bashing to rest. And then I also want you to focus more on what's important, which is picking the right style for you. That's what's important. You might have a friend and be like, why do you do that? You should be day trading. It's like, maybe day trading works for you, but long-term investing works for me. Or maybe crypto works for you, but Forex works for me. Or maybe options work, or just regular stocks, or whatever the case may be. So I really want to dive into this topic, talk about some of the traps and pitfalls. I had this really nice deck prepared for you guys, but I'm going to show some of that. But I think I'm going to go whiteboard style today. So let's go into screen share mode, and then we'll talk about it from here. So let me make sure this is fitting inside of our screen here for you guys to see. And we're going to break it on down. So this is why you want to have this stuff resized and ready before you start. So here we go. So we're going to be talking about the four different investing styles today. So there's many styles, but the four that I came up with that most people are going to be familiar with are these four. And under these four, you're going to have these subcategories. All right. So you got the long-term investor. That is a type and a style of investing. And then maybe some of the subcategories under long-term investor might be like you're a value investor. Um, you know, you might be in a 401k or some type of retirement plan. Those are going to be like subcategories of long-term investing. So they're not necessarily styles. They are different ways and accounts, whether that's to, save on taxes or get a match from your company, that you're going to be using to invest long term. Does that make sense? Now, if we stick to the left side, you got the dividend investor, which again still falls under that long-term side, but it's a different style of long-term investing, and we're going to talk about that in a second. Then you got the day trader. So the day trader, which we're going to break down, you got, the person that wants to go in daily and try to make money. Totally the opposite of the long-term investor. However, there is a place in society for the day trader, whether you like them, love them, or hate them. They do have their place in the stock market, and they also bring liquidity to the game. You notice that with the invention of stocks or apps like Robinhood and commission-free trading, you have a lot more day traders coming into the market, mostly kids, young adults who are just got $500 or $1,000, and they're like, I can just grab something, try to make some money real quick. And, they don't need a lot, right? If you're a college student or you're living in a dorm, I mean, if you can just jump in with 500 to $1,000 and turn it to 500 to $1,000 in one day, I mean, doesn't that beat working at some pizza joint delivering pizza on the weekends, making like $2 and hoping you get tipped or whatever the case may be? So there is a place for day traders in the market. And then we'll talk about the different styles of day trading, because you could be day trading stocks, penny stocks, options, Forex, all this other stuff. The whole goal is that you're in and out in the same day, which we'll talk about. Then there is the swing trader. And the swing trader is mostly, I like to call the swing trader an opportunist. Okay. So when you're swing trading, what you're basically doing is you're looking to catch swings or movement in the market or in a particular stock and capitalize on it until that swing or until that momentum ends. So we'll talk about that. So under swing trading, you also have like momentum trader, right? You also have trend traders underneath that. There's all these subcategories under swing traders, but the big picture is that you're looking to catch these swings, right? Where a stock swings up or a stock may swing down. You're looking to catch those swings. So if that makes sense, let me know in the comments or hit the like button, send some emojis our way. So just that I know that you're with me and this is making sense. So, but there's also one style that we haven't talked about yet. And that style, I like to call this the custom category. And so me and the style that I teach, we fall into a custom category. And I came up with the term myself because I remember someone asked me, it was on either YouTube or Facebook. They said, like, what type of trader are you? And they're like, are you a day trader? It seems like anytime someone hears about trading or investing, they always immediately go, are you a day trader? And I'm thinking as if that is the only type of trading or investing there is to do. People just immediately go to day trader. And I said, I'm not a day trader. And so you're a long-term. I was like, well, I'm not long-term. I was like, I'm a power trader. And that really stuck with me because, we created Power Trades University, but the way that name came about, stick around because we're going to talk to you about what it means to be a power trader, which is actually a hybrid or a blend of multiple different styles, which we'll talk about here in a second. All right. So let's dive into style number one. So style number one, as you can see here, is the long-term investor. Now, this is typically the most boring trader or investor to be. But here's the thing. Don't confuse boring with making money. Okay. Making money doesn't necessarily have to be exciting. Okay. It's exciting to go down to the casino, but most people lose their money. It's exciting to buy a lottery ticket every day for the next 30 years and never win. Okay. That's exciting. That's a way to potentially make some money. And it's exciting, except most people don't ever walk away with any cash. But when you look at the long-term investor, it's boring. So I just want to put that out there. It's boring because there's nothing to do every day and you have to forecast out down the road. All right. So long-term, you're thinking down the road. How far down the road? At least, I would say at least 5 years. So when you think about setting up a portfolio, you typically don't want to change that portfolio for 5 years, right? Because you're long term. You're not caught up in the day-to-day fluctuations. You're not caught up if a company had a bad year, like Facebook, for example, when they had the Cambridge Analytica scandal. Yes, they might have had a bad 6 to 12 months because of that. But long term, people came back to the platform to use it. People came back to the platform to run advertisements, right? So when you're in the long term camp, you're thinking 5 years out. Is this a company that's going to be here today and tomorrow and 5 years plus from now? Slow and steady growth is the name of the game when we're talking about growth stocks. All right. So slow and steady just means like when you look at a chart, you want it to just slowly and steadily be going up. It doesn't have to move 10, $20 in a day. Doesn't have to do the Tesla, right? Was up $100 one day, down $50 the next day. But you just want to see it to consistently climb, because when you get to the end of that long-term road, you need it to be higher than it was when you made the decision 5 to 10 years ago to get into it. All right. And that's what's important to you. Now, typically, if you're long term, you're doing investments or trades that probably pace the market, because it's it's probably a little tough to look out 5 years and see how can you beat the market, right? But you're probably saying, at least I want to get the standard market rate of return, whatever the S&P 500 is returning to investors every year. And that's simple to find. You can take the price of the S&P 500 on January 1, take the price at the end of the year, right? Subtract it and get the difference, and then divide that by the total cost of the overall market. And so you get the percentage move, right? So like, did the market move 10% this year or 15%? And so what you're looking at is, if I were to just put $1,000 in the market, the general market, I didn't try to beat it. I didn't try to pick individual stocks. I just went with the market or a fund that mirrors the market. Would I have at least gotten that 10% return that the market did, no matter what? All right. And so that's your game right there. And then you're also playing what we call the average price game. Okay. And so what the average price game is, let me move this down. So the average price game, what that simply means is, you're okay if you buy 100 shares at $50, and you're okay if it drops down to 40 and you buy another 100 shares. Because when you're investing long term, the main goal is that you are consistently putting money away into an account to invest. And so you understand that over time, sometimes you're going to be buying it at a higher price, and over time, sometimes you're going to be buying it at a lower price. But big picture, okay, the big picture is that you are buying something, and you're buying some. And as you continue to buy, maybe you bought some at 50, maybe you bought some at 45, and then your average price, you're in there at 47.50. But long term, if the stock's going to 55, 60, 65, 70, that's all you care about, is that you continue to participate, sometimes at higher prices, sometimes at lower prices. They call that dollar cost averaging. Okay. So that is the long-term investor. But what are some of the cons to just being a long-term investor? Okay. So some of the mistakes that people make, and I think I'm gonna bring the whiteboard on for this so we can talk about some of the mistakes that long-term investors make. So let's go whiteboard style here. All right. So some of the mistakes that long-term investors make, and I want to help you avoid these. Okay. Just because you're putting your money away for long-term does not mean. So some of the mistakes of long-term investors. This is one of the big mistakes that I see. They set it and forget it. Okay. So this is a big mistake that I see that long-term investors make. They set it and forget it. So what do I mean by they set it and forget it? You ever talk to somebody and you say, like, do you invest? And they say, well, I got a 401k, right? And you're like, well, how's it doing? And they're like, I don't know. I never look at it. Or you ever talk to someone and, you say, how's your investments doing? You say, 10 years ago, I used to work for a company. I was putting some money away. I should probably look into that. I probably still have an account with that company, right? And so that is the set it and forget it method. The problem with the set it and forget it method is, because we like to look at about 5-year time frames when you're thinking about long term, most professionals or licensed investors will even tell you that you typically should look at your portfolio every 5 years. And so what happens is, every 5 years, if you forget it, what happens if you're stuck in a company like Ford Motor Company, right? And no disrespect to Ford Motor Company, anybody work for Ford, but I always look at Ford because here in Michigan, being from the Motor City, people used to be like, just buy Ford stock or just buy the automotive stocks. And one of the issues with just buying Ford and set it and forget it, when you look at a stock chart of a company like Ford, what you end up left with, and I'm gonna see if I can pull it up for you. If you look at the stock chart of a Ford Motor Company and you look out over time and you just set it and you forget it, you're just like, it's Ford, it's a good company, long term, I'm gonna be okay. And I talk about this in my online webinar presentation. When you look at what that stock has done over the last 20 years, it's done absolutely nothing. And one of the saddest things that you can do as a long-term investor is put some money away, forget about it, and think that you're on track to retire. Think that you're on track to make money, only to look up and find out that 20 years later, 20 years later, it actually did nothing. So let me share with you what I mean by that. And this is one of the biggest mistakes of long-term investors. All right. So if we go back here to this chart, I just want to show you a chart of Ford Motor Company. Okay. If we zoom out, and you could go all the way back to, this is 2011. Okay. So, well, let's go here, 2013. So you can see 2013, it kind of peaked around $12.50. So if you bought Ford stock and you set it and forget it for the last 5 years, look what happened. So we'll go from 2013 to, let's go to about 2018. All right. February 2018. Basically, this is what the stock did over 5 years. You guys see that right here, 2018. So the stock basically did nothing, from 12.50 down to 11. So if you didn't analyze your portfolio every 5 years to say, is this a stock I should still be in? This is where long-term investors or set it and forget it makes the mistake. You could have moved this to something else instead of watching it now go from 10 all the way down to $4, right? And then it recently rebounded to 7. But simple math, if something went from $10 to $7, what did you lose? Okay. It's very simple what you lost. You lost 30%. But did you lose 30% or did you lose more than that? And the reason I say did you lose potentially more than that is because you also lost time that money could have been in a different investment for the last few years if you would have analyzed your portfolio and figured out like, it's time to move money. So that's one of the biggest mistakes that long-term investors make, is they set it and they forget it and they think that stocks only go up or their portfolio only goes up. But the question is, are you in the right mix of stocks? Are you in the right portfolio? Or do you need to make some type of adjustments? All right. Now, here's a mistake that some people make, not necessarily being a long-term investor, but some people make the mistake opposite of long-term investors. And that is they do nothing. Right. And so this is a big mistake because when you do nothing, so what I mean by do nothing is, I've talked to people before when I used to work in corporate America, and I say, hey, I'll never forget when I worked at Comcast, I said, look, the company is matched. They're giving us we had a employee stock purchase program. We could buy the stock 20% off. So the stock was trading at like $40. I'm like, we get the stock at like 32. Like, you can't beat that. I think it was 20% or 15% off. Even if it was 15% off, stock trading at 40, right? 10% is $4, so $6. I'm like, we get it at 34. We get to come in $6 cheaper than anyone else. But one of the caveats was you couldn't sell your stock for a year. So you had to hold it for a year. I'll never forget, some people were either so strapped financially that they couldn't set aside the money and let it sit for a year, or they had the mindset of, man, a year from now, that's a long time. And so they did nothing. They didn't take advantage. But I think about it, if you really think about your life right now, most people, if you work a job, you're setting aside money every month to the government. The government is taking more than they should out of your bank account. By the way, they're picking up garbage outside. I hope you guys can't hear that. Hopefully it's not too loud. But every month, at the end of the year, when you get a tax refund back, that simply just means the government took more money out of your account than needed to be taken out. And at the end, they say, hey, here's some of your money back, right? And so you get excited about a tax refund when in reality, it's your money, right? They don't pay you any interest on it. They don't pay you any dividends on it. They don't pay you anything. They just say, here's it back. And we gladly take it. In fact, not only are we glad to take it, we're glad to go pay H&R Block or somebody to let them know that they took too much money from us, right? So if you really think about it, big picture, it's a bad deal. But some people, when it comes to investing long term, it's like, I can't set any money aside. And a year from now, that's too long of a time frame for me to see a return. When in reality, you're already doing it when it comes to your tax returns. All right. So we're going to move on from the long-term investor. But again, I just wanted to show you that when it comes to the long-term investor, these are the mistakes that people make. They set it and forget it, and they don't evaluate. I typically recommend reevaluating your portfolio every 5 years. And then the opposite end of that is some people actually do nothing. They don't even get involved to take advantage of what could potentially happen long term if you let it sit long enough. All right. So let's go back here, and then let's talk about the next type of style of investor, and that is the dividend investor. All right. So this person is also long term. And I used to think, like, why are people so excited about dividends? Like, why are dividend investors so pumped? But when you understand how it works, it makes sense why certain people are excited about dividends. All right. So dividend is still a form of a long-term investor, because let me stop and pause right there. You well, let's keep going. Let me go through these. Then I'm going to talk about how you want to look, why you're still a long-term investor, how you need to think about it. So number two, a dividend investor is a person that is long-term, but they're looking to get what I like to call a drip. Okay. They're looking to get a little bit of payout while they're waiting, right? So it's like, I'm willing to wait, but while I'm waiting, can you kick me a check every now and again? So dividends are typically paid quarterly. And depending on how many shares you got, you will earn a quarterly dividend. So about 4 times a year, which is a lot better than your tax returns, because you only get that 1 time a year. But the dividends, you're going to get paid a quarterly dividend depending on the company. All right. And so they call this a yield. So a company may say, we're paying a 10% yield. Okay. So you have to figure out, is that 10% yield quarterly, or is that 10% yield annually? Typically, the 10% yield is annually. So what that simply means is you're going to take the 10% annual yield and divide it by 4. And that's what your quarterly payments would be based on, what type of stock that you own. All right. So you're long term, but you're like, can I get a drip every quarter? Can I get a little check to kind of tide me over while I'm waiting for the big payout someday? It's kind of like rental property almost, right? You got the property, you're hoping it goes up in value, but you kind of stick a renter in there to get a check every month as you're waiting for the property to increase, and you hope they don't tear up the property. Well, same thing. You're hoping to get a check every quarter, and the property is the stock. You're hoping the price increase. You don't want the CEOs or the owners to do anything that'll tear up the stock. Like, you don't want anyone to tear up your house, because you don't want the price to go down. So you're looking for something that has slow and steady growth. Typically, it'll pace the overall market. And again, you're in this business to get paid to wait. But let's pull up the Ford example, because I want to bring this up, because I think some people confuse the idea of holding a dividend stock that's going down. Okay. So if you're getting paid a dividend, and let's just say your dividend is 25 cents a quarter, right? So per share that you own, you'll get paid 25 cents. All right. So if you own 100 shares, you'll get paid $25. Does that make sense? So you're going to get paid $25 a quarter, which means $100 a year. Don't mistake that though, because think about it. If you get paid $100 a year, you know, 100 a year, 100. These aren't even, I don't even know if I'm doing these right by years. But the point is, you might make 1, 2, 3, $400, right? But if you got a stock that goes from 13 down to 4, all right, you eventually basically lost what's that? Would that be $11? Or no, not $11, $9. So you eventually lost $900 as the stock fell from $13 all the way to 4. But we just looked in this time frame from November 2013 to we're in May, we're in, I don't know, August 2020, but just 2013 to 2020 is what? 7 years. Okay. So what am I trying to show you? Even though you made $100 a year for 7 years, you still lost $900 in the value of the stock at some point when it came down to 4. Now it bounced back up to 7 here, but I mean, even if it bounced back up to 7, from 7 to 13, if you bought it at 13, you're basically down what, $6? So you've given back 100, 100, 100, 100, and you're still negative 600, even if you're saying, well, it's back up to $7 right now. That is the reason why, if you are going to get into a dividend stock, you want to get into a dividend stock that is actually going up, because as you're getting your $100, 100, you also want your original equity to be going up too, right? So you want to be like, oh, and now the stock is also worth more, and I've been getting paid these $100 to wait while it was going up. Let me know if that makes sense, because I really want to drive this point home and understand the dividend investing, right? So you want to make sure that you're in a stock that's actually going up long term versus being excited that you're collecting a dividend on a stock where you're actually losing the principal. That's just like buying a house in the neighborhood that's declining, and you're like, I'm excited, I'm getting $200 a month. But this asset you paid $10,000 or $20,000 for is now worth 18,000, 16,000, 15,000. But you're collecting $500 a month in rent, right? So you're making $6,000 a year, except every year your property value is declining by $3,000 to $4,000 to $5,000. It doesn't make sense. So when you're thinking about dividends, you have to think long term. You have to think, is this stock going up? And then I'm looking at the yield to get paid to wait. That's what you're thinking about. All right. That is the game plan and the mindset for a dividend investor. Now, so I know I did the biggest mistakes, but that is the biggest mistake that a dividend investor can make, is picking a stock that pays a yield on a horrible stock that's declining. So that's what you want to look out for if you're looking to get into dividend investing and you're like, this is great, but it's like, are you in on the stock that's declining and you're getting a yield on something that's not going to be worth much in a few years? Because that is a problem, my friend. So let's go back to the chart here. Okay. And Oliver just brought up a good point. Let me throw that up here on the screen, right? So Oliver brought up a point that says the real key to dividend investing is to reinvest your dividends. All my dividend stocks purchase new shares with the dividends. That's also a strategy, right? So if you're getting that $100 a year drip, you could do a couple of things. You could take that money and just, take yourself to a nice dinner. I'm just using 100 as an example. Depends on how many stocks you have. But you also could take that and say, how many more shares of a stock like Ford could I buy now? Now that I got paid my $100 in dividends, could I buy another 100 shares or whatever the case may be? And so then you get into a situation where you're doing what? You're compounding your investments, which just simply means you started with 1,000 and they paid you 100. Next year, you start off with $1,100 worth of stock, and then it compounds and you get paid $100 again. The following year, you start off with $1,200 worth of stock. And so you're starting to compound your investment. So hopefully the stock is still going up. Plus, the dividend money that you're getting is allowing you to buy more stock. So guess what? If the stock is going up, you have more of it going up. And you're also getting more dividends because your dividends from the previous year or quarter bought more stock. All right. So great point of bringing that up, Oliver. That's also one of the benefits of doing some type of dividend investing. What I find is you typically have to have a decent amount of money to see the fruits of the labor of dividend investing, right? So it's not like, oh, I got $100, I'm gonna buy something and get dividends. It's like you can't buy enough shares to see it. But remember, don't be like the guy who does nothing and doesn't start investing because, well, if I can't buy 10,000 worth, I'm just not going to do anything. Don't be that guy either. I'm just saying, when you start to look at the different styles, typically if you're sitting on $1 million, I'm just using this example. You don't have to have $1 million to get dividends. I don't even want to see this and be like, if I don't have $1 million, I can't do dividends. You could do it at 1,000, 500. You could do it at any dollar amount. But I do want to give you an example. If a guy has $1 million and he wants to safely safeguard that money, he may buy long-term reliable companies that have been around and will be around, and then collect the dividend. They may not be growth stocks like Tesla because he doesn't want that account to be up $1 million, down to $500,000. He's like, I just lost half my net worth. So he might buy slow growing, dividend paying stocks, which sometimes are typically Dow component stocks. But off $1 million, if you're getting that drip every quarter, this guy might be making $10,000 a year just off dividend stocks, right? If you divide that out, it's $900 or so a month. That might be good money for his lifestyle. Maybe he's making $20,000 a year off dividends. Just depends on how his portfolio is structured. And you're talking about $2,000 a month. That's not bad when you divide it out. Even though you get paid quarterly over a year, if you're making $20,000, you divide that out to $1,800. That's good money if you still have a pension from another job, if you're getting your retirement check and you're clocking another $1,800 off your $1 million because you learned how to dividend invest. All right. So there are some benefits to it, but you just have to understand, okay, if I'm going to be in that camp, I got to have a long-term mindset. I also got to figure out, how do I grow my account to 100,000, 200, or $1 million over time? If I consistently put in $300 a month, whatever the case may be, this is the lifestyle I could have in 20 years, 30 years by the time I retire, or whatever the case may be. Now, let's talk about day trader, and then we'll go to swing trader. So I didn't create a slide for this, but we'll draw it out. So a day trader, this person, it's the most simplest type of trader there is. The day trader is simply going in every single day and looking for an opportunity. I guess you could say a day trader is somewhat of a swing trader, but the day trader is going in every day looking for opportunity. And so let's go to the whiteboard because I want to talk about the game plan of a day trader. All right. Because some people say, well, day trading is risky. It's risky. Everything is risky if you don't know what you're doing. All right. So here, let me bring up, let me get a new sheet. All right. So let's talk about my friend, the day trader here. All right. My friend, the day trader. Let's talk about his goals and then let's talk about the mistakes. All right. So here's the goal of a day trader. And then down here, we're going to talk about the mistakes of a day trader. Or should I say the pros and cons? All right. So the goal of a day trader, number one, wants to make money every day. Okay. So a day trader is going into the market and looking for an opportunity to snatch out some type of profit every day. This is the goal. Okay. Now, how much profit doesn't matter. Okay. So the other goal is to never hold overnight. You don't want to hold any positions overnight, because everyone knows that information or news can come out overnight and kind of hammer the market, and like some trade that you were loving yesterday, you don't like today. The other goal of the day trader is, I shouldn't be making dollar signs, but the other goal of the day trader is to capitalize on volume. Okay. I don't even know if I'm spelling that right, but a day trader wants to capitalize on volume. Okay. And so when you think about capitalizing on volume, I want you to think about this. If a stock moves like 50 cents or $1 in a day, you might think like, it only moved 50 cents. What am I going to do with that, right? It's not that much money, but let's talk about volume. So let me go back to the screen share and talk about volume, because this is where day trading magic happens. It happens in the volume. You're not looking, see, when you're long term, you're like, it can move $5, $10, $20 over the next 5 years, maybe. When you're short term, you're like, can it move 50 cents today? All right. And when you're thinking about, can something move 50 cents? What you're really saying is, as a day trader, let's just say the cost of a stock, let's say a stock price is $5, okay? As a day trader, if you can get 1,000 shares at $5, that's going to give you, that's going to cost you $5,000, right? Now, if that same stock moves, points 50 cents in one day, okay, 50 cents in a day, that's nothing crazy. Just went from $5 to $5.50. Stock moves 50 cents. You got 1,000 shares, right? So you got 1,000 shares times 50 cents. Simple math. 1, 2, 3. You move the zero over. You make $500 in the day. $500 in one day. That's why this is about the volume game. Now, let me ask you this. What if you could buy 2,000 shares at $5? It's going to cost you 10,000, but guess what? Now you only need the stock to move 25 cents just to make 500 in a day, right? Because if you double the amount of shares, then you divide in half how much the stock has to move. So now it only needs to move 25 cents in a day for you to make some money. So let's just, I don't know, let me humor myself here, and bring something up. Since we were talking about Ford, let me humor myself. Okay, well, it didn't move 25 cents in the day. So I was looking to see if it moved 25 cents today to give you an idea. All right, but we could technically, here, let me look for something real quick. I think we got a scan. Average trading range. Let me see. Do I got a scan for stocks? I know I had like a day trading cheap scan before. Here we go. Stocks that close between $5 and $10. So you can also build scans for this. So who's that? Okay, AMC. Let's look at AMC together, guys, because this is a $5 stock. Because I just want to show you that it's possible, right? So let's just look at this AMC. Okay, well, today it's not. It didn't do it. But it looks like if we go to a 5-day chart of this, well, here, we could just do it here. If we look at this chart, this is why it's important to learn how to read stock charts. If we look at this chart of AMC, it opened right here, which is what, 460, and then it closed right here, which is about 530. Does everybody see that? So 460 to 530. That's like what, almost an 80 cents move from the next day. So I'm just trying to show you that a stock can move 50 cents in a day, right? If you look at the day before, this is August 20th. Look at this day. If it opened right here, matter of fact, let's put the crosshairs on it. If it opened right here, 406, you see this number over here, 406. This is where it opened, and then it ran up to 474. Does that make sense? We got a day trading course that we're coming out with that I'm going to talk more in depth on how this works. But big picture that I want you to take away from it is that the day trader is all about capitalizing on volume, right? If I can buy enough volume, I can take advantage of a very small move and I can get in and out. Now, let's talk about the mistakes that a day trader makes, right? So, number one mistake a day trader makes is getting greedy. And what does greedy look like? They want this, number one, they hold, well, there's tons of mistakes, right? So if they get greedy, what happens when you get greedy? You hold it overnight. So that's one of the big mistakes that a day trader can make is they hold it overnight when all they were trying to do was get in and get out. The second thing that a mistake that a day trader makes is they try to make money every day. Now, you may be saying, wait a minute. You just said the day trader's goal is to make money every day, okay? While that is the goal, that is also the mistake that most day traders make. And why is it a mistake? Let's break it down. We tell our members inside of Power Trades University this all the time. We say, sometimes there's nothing to do. Sometimes there is no good trade. Sometimes there's no good investment. There's nothing. And when we say no good, there's no low risk stock to buy, no low risk option to buy right now. Sometimes we do our webinar and we say, guys, I got nothing for you to buy this week. Maybe 2 weeks in a row, there's nothing to buy. We're waiting for a pullback. But what happens with a day trader is because they said, I got to make money every day, they don't give themselves the grace sometimes to wake up and say, it's actually okay if I don't find a trade today. And so what happens is they try to force a trade, right? You're looking, you don't see a trade and you try to force a trade. And then when you force it, you end up losing yesterday's profits or the day before's profits, or you lose multiple days in a row because you try to force it. I typically teach if and when we day trade, we only day trade when the opportunity presents itself. I don't wake up every day and say, I'm going to make 500s a day. Although you could, right? You could. There's a systematic way to do that too. But you also have to understand that some days there is no trade. And that's one of the biggest mistakes that most day traders make is that they're always on the hunt and they're willing to take a riskier trade than they normally would because they feel like they have to do something today versus saying there was no money to be made today. We'll try again tomorrow. So those are probably the two biggest mistakes. They get greedy and hold overnight. They try to make money every single day when sometimes there is no trade. And then the other mistake that day traders make is that they don't have not enough volume or volatility. Okay. And all that simple, I'm just going to say vol, that's volatility. So if you're watching volume and then volatility, now I should spell it out because it looks like I just wrote volume twice. This is volume or volatility. What that simply means is they're not coming in here with $1,000 and buying 1,000 shares. They're not coming in with enough money to buy 1,000 shares. So some day traders get in, but the stock moves 25 cents, but you don't have enough shares or enough money to make any good money. That's one of the mistakes. Or let's say you only got $1,000. Then you should be buying a stock that can move $10 in a day. Maybe you're grabbing a Netflix, a Tesla. And even at that point, maybe you're grabbing the option because you still can't afford the actual stock. So you're either looking for volume on a stock that doesn't move much, but you own so many of it that even if it moves 25 cents, you made $500 today. Or you're looking at, okay, I can only buy one share of Tesla, but that bad boy moves $100 in a day. I make $100 today. So you're looking for volatility, something that moves big up or down, or you're looking for volume. Does it move big? It doesn't move big up and down, but I own so much of it, even just a little bit or the slightest move in it will put us where we need to be. Let me know if that makes sense. I know, I want to make sure this is vibing with you. Whether you're watching live, let me know in the comments. If you're watching on the replay, you can comment on the replay. But I want to make sure, does that make sense? The game that you're playing as a day trader and as you're trying to get volume and different things like that to make it worth your while, or you're trying to get volatility to make it worth your while. If you can't buy as many shares, then you need that stock to be one that moves pretty, we say violently, but like moves pretty big. All right. So then there's the swing trader. All right. Awesome. Glad that this is making sense. Abnamir says, great information. Chris Green says, all good. Awesome. That lets me know that you guys are alive out there. All right. All right. So that's the game plan. Now let's talk about the swing trader. Okay. So the swing trader doesn't actually have a time frame. Okay. So the swing trader doesn't really have a time frame. The swing trader is an opportunist. Okay. So swing trader is neither bullish nor bearish. Swing trader says no matter which way the market moves, this is where I'm going to take my opportunity. All right. So let's break down what does that look like to be a swing trader. And I think the best way to show you is by looking at the stock charts. And by the way, so glad to hear that this is making so much sense. Beatrice, R.A. Torrey says, how can we get information on your class? My team will let you know about that in the comments. Douglas is make perfect sense. Cassandra says it's making sense. Cool. Let's go to the chart and let's talk about the game plan for a swing trader. And then we're going to talk about being a hybrid trader. Okay. So let me bring up the charts and then we'll switch and we'll talk about what it means to be a swing trader here. Okay. So here we're looking at my charting system. So let me pull up, for example, Apple. Okay. So what I like to tell people is Apple's a good company, but they're still good or bad. No, let's do Facebook. I think Facebook is a little bit easier to see. Okay. So Facebook's a good company, but there are also good times to be in Facebook, but there's also bad times to be in Facebook. So let's walk through what that looks like. If you look back here, a swing trader says, when it's doing this, I'm going to swing bullish. I'm going to swing bullish and I'm going to trade it bullish. Okay. Then when the momentum changes, unlike a long-term investor, when the stock goes down, a swing trader now says, I'm going to swing bearish. All right. And what that simply means is a couple things. You might even close out your trade right here at the top and wait, or you might close out your bullish trade and then you pick up a bearish trade. So maybe you pick up a put option. Maybe you short the stock. So a swing trader has no loyalty. A swing trader is just looking for opportunity. And then a swing trader says, yep, I'm back swinging bullish. I'm going to swing back bullish because the stock's momentum has changed. So I'm going to swing bullish now again, right? And then a swing trader might might swing bearish and say, you know what? I'm no longer bullish. And so basically a swing trader is changing their mind based off the data that the chart is giving them. Now, how's that different from a long-term trader? A long-term investor, let me go purple. What color can I use? Long-term investor says, I'm going to sit through this up. I'm going to sit through this down, and I'm going to sit through this up. So long-term says, I'm in this for the long run. Where the swing says, I'm only in this as long as this keeps going up. The moment it starts going down, I'm done. And then it goes down. Swing trader might say, I'm going to buy some put options, or I'm going to swing and play it to the downside. Or swing trader says, Now that it's look like it found a bottom and it's going back up, I'll jump back in. And so the swing trader's goal is to avoid losing money or giving back profits during these red areas, or you become a hybrid trader or a power trader. And not only is it not about giving money back during these down periods, how can I try to capitalize on these down periods? Whether that's trading options, buying put options, shorting the stock, whatever the case may be. So this is what a swing trader would do. Now, let's talk about some of the pros and cons, or the biggest mistakes that a swing trader can make. Okay. So let's write it in black, and then we'll write the mistakes. All right. So I just told you what their game plan is. So I just want to focus on the mistakes of a swing trader. So some of the mistakes that a swing trader makes is, number one, they don't know how to read charts. Okay. So anytime your friend comes to you and says, should I buy Facebook? And it's like, well, did we look at the chart? Is it going up or is it going down right now? So you want to be able to look at the chart. So if you don't understand how to read charts and determine when to swing, that's a problem. That's why trading, whether it's day trading, swing trading, gets a bad name. And people say it's just gambling, because you have these people who come to the table who don't know how to read a chart. Okay. And so that's one of the biggest mistakes that swing traders make. I think maybe even bigger than number one is swing traders, or a bad swing trader, I should say, doesn't know how to control their emotion. There are times where I do a webinar for our members. I can say on Monday, I like this stock. By Friday, I'm saying I'm closing out, taking profits. I don't like it anymore. I can always tell who's not a swing trader in our community when they say stuff like, we liked it yesterday, or last week we loved it. What do you think I should do? The chart has told us, let's go back to Facebook. The chart has told us that, yes, we liked it last week or last month. Now we don't like it anymore because it's falling. Okay. And I could be like, I don't like Facebook. And then I could literally come back in a week and be like, loving Facebook. And you're like, this guy tripping. What is he talking about? All right. He just said he don't like Facebook. And all of a sudden he love it again. That's because I'm looking at the chart. I'm saying, I love it. Okay. I don't love it no more. Okay. I love it again, guys. I don't know if I love it anymore. Okay. It turned back around. I love it again. And so to the average person on the outside, you're so emotional about your money. I was just in it. I thought this was going to be the one that was going to retire my kids, or I thought this was the one that was going to retire me from my job. Where I'm like that guy that you don't want to date when it comes to a stock. It's like, I like you as long as you're doing something for me. I like you as long as it's benefiting me or I'm getting something out of it. Then I'm moving on to the next stock, or I'll come back to you when you're working again. All right. When you're ready to take me out to dinner. This is like a horrible example using dating. But I know the ladies feel me, right? It seems like these guys only call you when they got something to benefit. Well, they're swing trading you, right? All right. Or the guys, right? She only calls you when she's need her rent paid or it's time to go out to dinner, right? She's swing trading you, right? And then once that rent's paid, she got her stomach full. She like, I don't know if I need them right now. Okay. So that is the same thing right here. As long as it's working in my favor and you're behaving, Facebook, I like you. The moment you start tripping, starting arguments, you're confusing me on which direction you're going. It's like a relationship. I don't need all this drama in my life. I'm done with you. And then when you start getting your act together, you hit rock bottom. Maybe you got arrested, okay? And you get out on probation and you start acting right again. Boom, I'm willing to date you again. That's how I feel about my money and these stocks, okay? So that's like the best way that I can explain swing trading, okay? I don't know. that's what I came up with. So, you know, if anybody's in a bad relationship right now, I want you to look at it like swing trading. Maybe it's time to let that buster go. All right. So let's talk about the fourth and final, which is hybrid or a custom category trader, right? So we have a term that we coin, which is power trading. Okay. And so what power trading simply means is we wait for a stock to swing in the direction that we believe is going to swing, and then we put a lot of power behind it. So we're a combination of the day trader, the short-term trader, the long-term trader, and the swing trader all wrapped up in one, right? Because if I see something swinging or turning around on a daily basis, I might jump in and day trade it. And then I'm going to come with a bunch of power behind it. Does that make sense? I might put $50,000, $100,000 into it. If you've seen my video where I made $100,000 in one day, someone said, well, how much money did you have in the trade? Well, I had $200,000 in the trade, but that's because that's what we call power trading. We wait for it to swing, and whether it's daily or long term, we spot that swing and then we come in with a bunch of power behind that trade. And that allows us to maybe jump in, snatch 100 grand and be like, I'm done for 6 months. I'm done for the rest of the year, maybe, right? Made the amount of money I would have made working my job. And so that's what we call power trading. It's a hybrid of long term, because we're looking for good stocks long term, or we're looking for bad stocks to short or long term. We will also take the opportunity if it's a day trade. We'll take the opportunity if it's a 2 or 3 month trade. We're not married to the time frame. We're not married to whether it's long or short. We're not married to whether it's bullish or bearish. What we're married to is the chart, the risk reward ratio, and can I get in with enough power to make it worth it to just get in, snatch my profit, and get out? And that's what we call the power trade. And there's certain patterns and different things that we look for to do that. And then we use options. So instead of buying the stock, we say, can we supercharge it with the option and really get in and get out and do what we like to call a power trade? All right. So that's the term that we coined for this right here that you can see. That's a custom category. All right. So you're taking the benefits of you're looking at the chart long term in case you have to get stuck holding it. If you're bullish, don't necessarily care if it's a dividend, but from that mindset, we're trying to get a drip as a power trade. I'm trying to get in and get out, not necessarily wait the entire year, but if I have to, I will. If I see that opportunity on the day, I'll take a day trade. And if I see it on a 6 to 12 month or longer, I'll take a long-term trade. And then I'm only getting into it if it's swinging the direction that I believe it's going to swing in. And then I'm going to put a bunch of power behind it. And so we call that power trading, ladies and gentlemen. So those are the primary 4 types of traders. And then again, those are subcategories underneath it, different subs accounts that you would open up to help you achieve that goal. So a couple things. If you're new to trading, I want to make sure you know about our stock market starter pack. So this is a free PDF download that we put together that'll help you read the charts. Obviously, we have our courses and stuff, but this is one of the free resources that we have that'll help you start to learn how to read the stock charts, how to open your first trading account, what to look for, what to get familiar with. And then when you want to start to learn how to supercharge it, or maybe you already learned how to know how to buy stocks and how to read charts, but you don't know how to necessarily supercharge it. And we do that with options. And so for those people, you want to download the free options trading guide, and you go to stockoptionstarterpack.com. This is where we break down what's an option, what does it mean to buy a call, buy a put, how does it work, how to make it work for you, and at least gives you a broad overview and a good understanding of how options work, and then how to get started with it as you start learning how to trade in the stock market. All right. So let me look at some of the comments before we wrap up. Beatrice says this is a good example. Perfect time. And talking to my 18-year-old about trading and dating. Awesome. Make sure he watches this replay. Grasher says, which trading platform is better to start with? Only 500 to $1,000 bucks. You can start with Webull, you can start with Robinhood. Inside that stock market starter pack, we talk about a couple different platforms, and you can get a free stock by using our affiliate link. But any platform that will allow you to get into the game is good when you got 500 to 1,000. Once you get, it's not even about how much money you have. Once you get more experience, you're gonna want stuff like level 2 quotes, streaming charts, stuff like that. And so you start to need more screening access, how to build custom scans. And so then you start having different needs from different softwares and different brokers. But for now, just getting in the game, TD Ameritrade, E-Trade, Charles Schwab, Webull, Robinhood, all of those are good platforms to get started with. Robert Rice says, we are in the trading business for profit and gains. Anything else is just like throwing spaghetti at the wall. Absolutely. We're just looking to get in and get out. So Raj asks, how can we use spreads as a swing trader? That would be too much for me to get into right here, but that's actually something I teach in my day trading course that we're releasing soon. But inside the day trading course, we do show you how to use that time premium of an option to sell it to somebody else and bring in like a little bit of a cushion. And then like at the end of the day, if the stock doesn't move, that option you sold, that premium ends up being profit to you, or at the end of the week, you can keep that premium or have a little bit of cushion if the stock goes against you. So that is something that we're going to be teaching in our day trading course. So we're just at the 1 hour mark. I appreciate you guys hanging out with me for this Money Mondays. I'll see you next week, same place, same time. Make sure you hit the subscribe button, turn on the bell notification to get notified when we go live for Money Mondays. And I hope this has been insightful with helping you learn how to figure out primarily what type of trader that you are, what type of trader that you want to be, and then what type of pitfalls that you can run into as a trader. So I'm going to run this promo so you can learn about Power Trades University, and then we're out.
Hey there, Jason Brown here, and thanks for watching my videos. I want to let you know about my premium group coaching program where my courses, coaching, and community is housed, which is inside of Power Trades University. Many times I get comments like, Jason Brown, I love your teaching. How can I get more of it? How can I work with you? So inside of Power Trades University, I've written courses like Foundations, which teaches you how to read stock charts, how to determine the best time to buy and the best time to sell. I'm also going to walk you through how to do fundamental research and the 3 most important profitable patterns and a whole lot more. Inside of Options Explained, which is my stock options course, I'm breaking down how to use calls and put options to supercharge your account in good markets and to protect your accounts in bad markets and potentially even make money from falling stocks. I'm also going to walk you through in my advanced options course how to use advanced strategies like strangles, iron condors, butterflies, all the advanced combinations to put together direction neutral strategies where it's possible to make money regardless if the stock goes up or down. You're also going to get access to me live 2 hours a week where I actually take what's taught in the courses and I apply it to the real market as I look for real trades with my real account and look to put real money to work looking for stocks and options to trade. You're also going to get access to our trading community of hundreds of other traders just like you, anywhere from beginners to advanced traders inside the community that are putting the information to work, sharing their charts, sharing their trades, getting feedback, learning, and growing their account every single day. So to get more information, just visit powertradesuniversity.com. And if I'm the coach for you and we have the courses for you, then we'd love to see you on the other side. Thanks for watching.